So every year your Social Security goes up, your tax, provisional income doesn't change. I just told you, I haven't seen a change in this since 2012. So the provisional income, the tax amount on your Social Security gets greater, or you trigger different brackets, or God forbid, one of you passes away and now you're a single filer instead of married filing, jointly file, and more of your Social Security is subject to tax. And the tax rate is higher. So you have to take more and more money out of your IRA. And of course, then you have opportunity costs. The more money you take out of your IRA, the less it stays in there and is able to grow. And that's where this really gets big, this compound number. So a simple $9,350 distribution to cover tax or less amount in your coming to you in Social Security can mean hundreds of thousands of dollars, literally hundreds of thousands of dollars over your lifetime that it's costing you because of that. So what's the answer? How do you manage this? Well, you got to ask yourself first, what is not counted as provisional income? Remember all these things we talked about here: earned income, pensions, right? Earned income, pensions, rental income, 1099s from the taxable bucket, distributions from traditional IRAs and 401ks, etc. Interest from municipal bonds, and one half of your Social Security. Well, for crying out loud, what is not counted as provisional income? Well, I didn't say Roth, right? I didn't say Roth. I didn't say Roth because qualified distributions coming out of your Roth IRA are not counted as provisional income. Distributions from a Roth 401k are not counted as provisional income. So you figure out the amount that you should have in your taxable bucket, that mathematically ideal amount. You figure out the mathematically ideal amount you have in your tax deferred bucket, and you can contribute or convert money into the Roth IRA. We learned about Roth IRAs, Roth 401ks, Roth retirement plans in the first part of this. If you haven't watched it, go back and watch it, because we talk about the overall goal. The overall goal, of course, is to get to net zero, right? That sounds like greenhouse emissions kind of thing. We want to get to zero tax in retirement, or as close as possible. The way you do that is that you identify how much you have in each bucket, or how much you should have in each bucket, and you push the rest into things that aren't going to cause you future tax pain. Yes, you have to pay tax now, but if you believe the taxes are going to be even a little higher, we know they have to be significantly higher, but if you believe they even have to be a little bit higher in the future, it can make sense to shift those monies over to this side of the ledger, right? Get those things over to tax advantage and tax free. Just the right amount of money here. Maybe you got some money over here and you want the rest of it to live here, so that anything that comes out of there is zero tax. Well, the first thing, I know I'm going back and forth. This is kind of fun for me, but so what's not counted as Roth or provisional income? I didn't say Roth, and I also didn't say properly structured cash value life insurance, or as my friend David McKnight calls it, a life insurance retirement plan. Properly structured distributions from life insurance policies do not count as provisional income, so they can help minimize or eliminate your taxation on Social Security. So again, you want to that's the two things that are truly tax-free are Roth or cash value life insurance, or also known as life insurance retirement plans. So you determine how much you need to have in each one of these buckets, and that's how you come to a tax balanced approach. I kind of like that phrase. So some people say, and I talked about married filing, joint versus single, just like your tax code, folks. As soon as one of you passes away, as soon as one of you is in the ground or whatever, on the mantle, in the ground, then your spouse has more aggressive tax rates, regular tax rates, more aggressive provisional income rates. They probably inherit your IRAs and your other accounts, so they inherit a bigger tax driver. All these funds that are driving all this tax, they inherit these things, and they're going to have to pay much higher rates just by the fact that one of you passes before the other, which is very, very likely, as you know, as you enter retirement. I think it's after you're in your mid 40s, the chances of you and your spouse dying at the same time dramatically drop. So when you're younger, it's much more common. But as you get older, of course, one of you is likely to go before the other. So what if? So people say, okay, listen, I've got a pension. I've got a $50,000 a year pension. That's automatically going to make my Social Security taxed into perpetuity, as you say, right? At, 85%, up to 85%. It would be 85% probably at that point. So what do you do? And is that what Walter's asking? So Dr. Paul, hi, Dr. Paul. I see a question. Since the 50%, 85% income thresholds are inflation unindexed, I'm already at the point that my Social Security income is subject to taxation, even if I had no other income, headed towards 85% regardless, Walter says. What a great segue. Thank you, sir. Yeah, what do you do? What do you do if your Social Security is going to be taxed anyway? Well, you darn well better protect the rest of it. If you can't control the fact that your pension is going to be taxed into perpetuity, or your Social Security is going to be taxed into perpetuity, maybe both things, well, then, your mathematically ideal amount in your tax deferred bucket isn't going to be the $2 signs. It's going to be zero. You're going to have to get all that money over to Roth or to cash value life insurance or life insurance retirement plan, whatever you can do to get to tax free or tax advantage. The only two things, I'll say it again, that are truly tax free are Roth, cash value life insurance, also known as life insurance retirement plan. So you may be able to keep a small amount of money over here. What do we want? We want 6 months to 1 year of expenses, typically. 1 year of expenses, typically. Anything more than that generates 1099s, interest, dividends, capital gains, all those things that generate more tax. All these things equal tax, and all these things take it out of your control. Right now you have control. You can make these changes and move forward. So if your Social Security is going to be taxed anyway, you better darn well move everything else over to, whoops, what happened to that? You better darn well move everything back to this side of the ledger that you can, because this is where your protection lies. Anything that comes out of here, as we know, you don't pay tax anymore on that. Yes, you got to pay tax to get there. And if you're meeting the requirements, there's a 5-year rule, all those different things. And the life insurance has to be properly structured. But if you're meeting those requirements, then you won't pay any tax on those distributions. And by the way, your heirs won't pay tax on those distributions. So I love one of the, I've heard Ed say it a million times, but he says, move things from forever taxed to never taxed. I like to say never taxed again, forever taxed and never taxed again. But he said something, and again, I've heard it, but it just clicked when he was here live for us. He said, what you're really doing is you're locking in your tax rate for life plus 10 years. So you're literally choosing the tax rate you agree to pay, and you make that choice. I'm agreeing to pay 24%, not more than that, for the rest of my life plus 10 years. So that's the kind of planning you want to do. And going back to what Sarah said earlier, it may not make sense to take delay your required minimum distributions. If you can get those inherited IRA monies out that you can't convert. She was talking about inherited IRAs. And again, there's one instance, and I can't remember the birth year, but there's the people that turn from 72 to 73. 73 is the new age for required minimum distributions until it turns to 75. But that's several years away. But those people that went from 72 to 73, they were also allowed not to do RMDs. But everybody else, mostly everybody else, has to do RMDs except for those folks in those few restricted sections, allowances. But it may make sense for you to take that required minimum distribution, because if you can get that required minimum distribution out at a 20% tax instead of a 40% tax, which would you rather pay? Of course, you'd rather pay 20. I use the analogy, back in the pandemic, I filled up my F-150 gas thirsty truck for $1.85 a gallon. If I could have bought all the gas I'd ever need for the rest of my life at $1.85 a gallon, I would have done it. Our goal is, we talk about inverted yield curves, things like that. So most people come to us, and in their plan, they show that we have these tax reports. So in their plan, the tax report looks something like this. So in the early years of retirement, you might have lower taxes for a short period of time, and then it just goes up exponentially. It actually looks more like this, right? We treat it differently. We like to do this: fill it up, and then ideally drop it down to zero. We have kind of this cliff. So you want to turn that upside down. Choose the tax rate that you want to pay, what makes sense for you today. Push everything else over to the tax efficient ledger side of the ledger. And that's, folks, how you get to zero tax or however close you can get for you. So that's a lot of information. I just like to zoom in to see where we started and where we are. You can go back and look at all 4 of these videos. This was a 4-part series, and we started, I don't know what day we started, but it was 4 weeks ago. But we started with how to get to zero tax. We started with Roth IRAs, and we talked about Roth. We showed the benefit to this for John and Sally here, the benefit to them to being tax efficient. You might remember at age 85 was about $2.5 million. So all this work of paying tax now, choosing your tax rate, what's better for you, it was a benefit to them of spendable money. Let's again talk about spendable money of $2.5 million more just by being tax efficient, not taking additional risk, not spending less, none of that, just by being tax efficient. So we looked at the why and the goal, and then we looked at Roths, as I said. Then we looked at where's my taxable account. We kind of jumped around a little bit. Taxable accounts, we were down here. We talked about those taxable accounts. There's 1099s that come out of those taxable accounts. The mutual funds that you just can't control. You can get capital gains when you've got a down year. That really stinks. And we talked about pensions. And again, the answer to the too much in your taxable account is you figure out you can pay tax out of it. You can pay your expenses out of it. You just want to draw that down to an amount that's about 6 months to 1 year of expenses. Push everything else over to the tax-free side of the ledger. You can use cash value life insurance or life insurance retirement plan. If you have a pension, all is not lost. You may have a lump sum option. So if you have a lump sum option, it may make sense for you to take that lump sum option and roll it over to an IRA that is not a taxable event. As long as you do it right, and it's really hard to do it wrong, you roll it over to an IRA, then you have a plan for converting those IRA dollars to Roth IRA dollars. And anything that comes out of a Roth, as long as you meet the guidelines, are zero tax for you and zero tax for your heirs. So that was part 3, pensions. And then this last part we just went over today was Social Security. And we talked a lot about Social Security. You can get to the 0% or 0% of your Social Security subject to tax. It's not for everybody, but when it works, it's beautiful. And when it works, if we are now getting zero, we're not paying tax on our IRA distributions. And we talked about how that works. We can take distributions from those IRAs that are below your standard deduction, and you can write off that entire deduction. You don't pay tax. It would still apply to provisional income. So you've got it. That's the art to it, folks. Any distributions from your Roth IRA are not subject to tax. Any distributions to a properly structured life insurance retirement plan, not subject to tax. And for your Social Security, if you're below the thresholds we talked about, also not subject to tax. And folks, that's how you get to zero. Again, if you can't get to zero, you want to get everything you can over to that side of the ledger, because the pensions and the Social Security tax is going to increase, and it's going to have a great effect. All right. That is it for today. That was a lot. It's great to see you all. It's almost the end of our hour. I look forward to seeing you next week. I do have the topic for next week, but I can't remember what it is. So you're going to have to wait until you get the notice via YouTube. If you love this video, share it. Give me good comments. I'm going to say hit the like, subscribe, and notification button. If you need to have questions, or you want to schedule time with me, you can reach us at questions@outofbarwealth.com. It's questions@outofbarwealth.com. If you want to go through and look at our awesome new website with a lot of information, you can go to outofbarwealth.com. There's, we have tons of videos on there and good information. I think there's 160 some videos that we've been doing throughout the years, and that's available to you. But I'd love to hear some feedback, some of your feedback on the website, videos, whatever works, things you'd want to hear about. That's always helpful too. I keep a running list. I probably have for the next several months with because as I'm talking to people or receiving emails, things like that, that always helps me figure out what I'm going to talk to you folks about and give me time to prepare. And that's always a lot of fun. So thanks for spending time with me. We'll see you next week. Have a great week. Take care.